Welcome back to the deep dive. Today, we are jumping straight into one of the biggest debates in all of crypto. I mean, it's a truly passionate one. It's dollar cost averaging versus buying the dip.
It really is the fundamental question, isn't it? Are you the Zen monk, just methodically buying every single week, rain or shine?
Right.
Or are you the market ninja, hiding in the shadows with your cash, waiting for that one perfect moment to strike when there's blood in the streets?
And it's so tough because you hear these incredible stories from both sides. We have to start with this one anecdote from our source material because I think you listening will feel this one in your bones.
The famous $69,000 trauma.
Exactly. So picture it. It's November 2021. Bitcoin hits 69K. And you're smart, you're savvy. You say, nope, not me. I am not buying the top. I'm going to wait for the correction.
Mm-hmm. A very rational thought.
So it falls to 48K. You think, still too high. Then it drops to 35K and you're feeling pretty good about your decision. You think, okay, the real floor is probably 20K.
And you're holding your ground, feeling like a genius, even as it hits 20K.
Yeah.
But then something changes. The news gets really, really dark. Companies are collapsing.
And when Bitcoin finally hits that $15,500 bottom in November 2022, you are so completely paralyzed by fear. You can't bring yourself to hit the buy button.
You get the discount you were waiting for, but it comes with a full-blown panic attack. So you do nothing.
Meanwhile, what about that boring guy who was just putting in his $100 every single Monday since 2019?
He's sound asleep. He barely even noticed.
Yeah.
His average cost is already so low that the volatility is just noise to him.
But we also hear the legends, the people who really did buy that COVID crash in 2020 or that 2022 bottom. And their returns they're just life-changing.
They're absolutely monstrous. So we have to figure out, is that repeatable skill? Or is it just dumb luck and survivorship bias?
That's our mission today. We are going to scientifically compare these two strategies. We've got historical data on Bitcoin and Ethereum, academic studies on market timing in general, and then we're going to dig into the psychology to help you figure out which method actually works for your personality.
So let's start with the cold, hard facts. Before we even get to the craziness of crypto, what do, decades of academic research say about trying to time any market?
I think most of us have this gut feeling that we can do it, right? That we're a little bit smarter than the average person.
And the data just kind of laughs at that idea. I mean, it's pretty clear. Timing the market consistently over the long run is, it's basically impossible.
Impossible is a strong word.
It is. But look at this huge study from Vanguard. It was published in 2023. They simulated over 1,500 portfolios using data going all the way back to 1926.
Wow, a century of data. That's pretty definitive.
Yeah, it's about as definitive as it gets. And the conclusion was just incredibly clear. The investor who tried for perfect timing, getting in at the bottom and out at the top, they actually ended up with less money than the person who just stayed invested 98% of the time.
98%. So just staying in the game was more important than playing it perfectly?
Almost every single time.
Yeah.
It shows the biggest risk isn't being in the market during a downturn. It's being out of the market during an upturn.
That makes sense.
And a Schwab paper from 2021 really drove this point home. It looked at the S&P 500 and found that if you missed just the 10 best days in the market each decade, your total profit dropped by 70 to 80%.
70 to 80% just from missing 10 days? That's insane.
Those few explosive days are where almost all the gains come from.
Yeah.
Let's apply that to crypto, where everything is on steroids.
Right. I can only imagine this effect is even more brutal for Bitcoin.
Oh, it's way more brutal. Since 2011, the 10 single best days for Bitcoin account for over 90% of its total gains.
Yeah. 90%. Okay. So if you're that ninja waiting on the sidelines for a 50% crash,
you're running a massive risk of missing the 3 days where it suddenly rockets up 200% and leaves you in the dust. The cost of waiting is just so much higher in crypto.
So the academic verdict is clear. The priority has to be time in the market, not timing the market.
That's the foundation for this whole discussion.
Okay, that sets us up perfectly. Let's move on and run the actual historical simulation. We're going to put these two strategies head-to-head with real numbers.
Let's do it.
So here are the parameters. We're investing $100 a month every month from January 2013 all the way through a projection for November 2025.
Okay, let's start with Bitcoin. First up, the Zen monk, the pure DCA strategy. $100 every Monday, no matter what. Price is $100, you buy. Price is $69,000, you buy.
That discipline has to pay off, right?
Yeah.
You're buying all those cheap coins during the bear markets.
It absolutely does. Over that entire period, with all that insane volatility, the final average cost for the DCA investor lands at around $19,800.
19.8. Not bad at all.
And if we use a conservative price target of, say, $97,000 for Bitcoin in November 2025, that portfolio is worth about $580,000.
Which is a return of?
Plus 480%. An incredible, low-stress, life-changing return.
Okay, fantastic. Now for the fun part. Let's look at the perfect ninja, the buy the dip master. This person only buys when the price falls more than 25% from its last all-time high.
Yeah, this requires almost superhuman patience and a ton of conviction. You're deploying all your cash during the absolute worst times.
We're talking about the big crypto winters, right? 2014, 2018.
Exactly. The 2014 to 15 winter, the 2018 crash, the COVID flash crash in March 2020, and crucially, that entire brutal grind down through all of 2022.
Just if they timed it perfectly, the result must just blow DCA out of the water.
It's staggering. The average cost for this perfect dip buyer drops to somewhere between $12,000 and $14,000.
Wow.
And using that same $97,000 price at the end, their portfolio value just explodes. We're talking $750,000 to $850,000.
So a return of, what, 600-700%?
Plus 650 to 750%. On paper, in a spreadsheet, the ninja absolutely crushes the monk.
Okay, that's for Bitcoin. But we promised an Ethereum analysis too. Does the dynamic change with ETH?
It does a little bit, yeah. Ethereum has historically been even more volatile than Bitcoin. The crashes are often steeper.
Which, in theory, should actually give the dip buyer an even bigger advantage, deeper discounts.
That's exactly what the data shows. If you run the same simulation since ETH launched in 2015, the DCA investor does great, of course. But the perfect ninja, who buys those massive 80–90% drawdowns,
like in 2018.
Especially 2018. The gap in returns between the perfect dip buyer and the DCA investor for Ethereum is actually a bit wider than it is for Bitcoin.
So the conclusion is the same for both. If, and that's a huge if, you could execute this perfectly.
You would be significantly wealthier. But that if is where the whole strategy falls apart for most people.
Right. This is the pivot from theory to reality. This is where the ninja usually stumbles and falls.
And it's because buying a dip isn't a math problem you solve in Excel.
No, it's an emotional battle you fight in your own gut when it feels like the world is ending.
Precisely. Let's really get into the psychology of a crash. Think about November 2022. Bitcoin is at 15.5. The FTX exchange has just vaporized.
It wasn't just a price drop. It felt like the whole system might be fraudulent. It was an existential crisis.
Total chaos. And we have data on this. On-chain analytics firms like Glassnode and CryptoQuant were tracking investor behavior. And get this, 68% of all existing Bitcoin holders were in the red. They were sitting on unrealized losses.
So they're terrified of losing even more. They're not buying.
They're holding on for dear life. So what about all those dip buyers who were waiting on the sidelines with their cash?
What did they do?
Their buying volume was incredibly low. The data shows most people weren't jumping for joy at the discount. They were frozen. They were waiting for what they called the final capitulation.
That mythical 10K or 8K bottom that it never actually came.
It never came. And this is the paralysis of fear in action. The perfect entry point arrives, but it's wrapped in so much bad news and terror that your survival instinct just screams at you to run away, not lean in.
We even have behavioral data to back this up, don't we? The Google searches.
Oh yeah, this is my favorite indicator. During that entire 2022 bear market, Google searches for the phrase "buy Bitcoin" hit the lowest level since 2018.
That's completely counterintuitive.
It is. If people were rational dip-buying machines, searches would have been spiking. But they weren't. People were scared, greed was gone, only fear remained.
So the people who waited for that crash, they just missed it. They either never got in or they waited until things felt safe again.
And safe meant buying back in at $30,000 or $40,000, wiping out the entire advantage they were waiting for.
And this is why, at the end of the day, DCA wins in the real world.
It wins for most people because it takes your emotions, your fear, and your greed completely out of the equation. It's a machine. It buys the dip for you without you having to overcome that primal fear.
Okay, so let's try to synthesize all of this. We're left with two kind of conflicting truths. Truth one, on paper, in a perfect world, buy the dip is the superior financial strategy.
No question.
Truth, too. In the real world, DCA is the superior strategy because humans are not robots and we panic.
The best strategy is the one you can actually stick with for a decade or more without freaking out. If you know you're a panicker, DCA has to be your foundation.
But there has to be a middle ground, a way to get the best of both worlds. What do the smart money players do? The institutions like MicroStrategy?
They don't pick one. They use a hybrid model,
Yeah.
the 70-30 or 80-20 rule. They build their strategy specifically to combat the weakness of human psychology.
Okay, let's break down that 70-30 split. What does that look like in practice?
It's simple. The majority of your capital, 70 to 80%, is for your automatic, blind DCA. You set it and forget it. Weekly buys, maybe even daily. This is your base. This guarantees you're in the market for those 10 best days.
The emotionally blind base.
Yeah.
I like that. So what about the other 20 to 30%?
That's your opportunity capital, your ninja fund.
Okay.
This is cash, or maybe stable coins, that you set aside. And you only, and I mean only, deploy it when predefined, quantifiable triggers are hit. You make the decision now so you don't have to make it when you're panicking.
So what's a quantifiable trigger in a market this crazy?
You have to be specific. For example, you only buy with this fund when the Fear and Greed Index drops below 20. Or maybe only when an asset is down more than 50% from its all-time high.
I see. So you're basically pre-committing to buy the panic. It takes your future emotional self out of the driver's seat.
Exactly. It lets you get the thrill of being a dip buyer, but only when the odds are massively stacked in your favor, and without ever compromising the consistency of your core DCA strategy.
That is some of the most practical advice I think we've ever discussed. It's the monk and the ninja working together.
It mitigates the biggest risk of all, which is yourself.
Okay, let's wrap this up. Key takeaway number 1. Consistency will always, always beat theoretical perfection. A 480% real return from DCA is infinitely better than a 700% theoretical return that you're too scared to actually execute.
And we have 2 challenges for you, the listener, to really bring this home.
Go on. Challenge number 1.
We're calling it the Calculated Cost Challenge. Right now, pause this, open your exchange, and calculate your real average buy price for Bitcoin or Ethereum. Be honest. Is it a low number that reflects disciplined buying, or is it higher because you FOMO'd in near a top?
That self-awareness is huge.
Okay.
What's challenge number 2?
The Emotional Recording Challenge. The next time crypto has a big crash, a 30–40% drop, believe me, it will happen. Take your phone. Record a voice memo. Describe how you actually feel. Are you excited or are you terrified?
And then record whether you actually bought anything.
Yes. Save that recording and listen to it in 3 years. I promise you, you will learn more about yourself as an investor from that one audio file than from 100 books.
That's a powerful one. We started this whole deep dive trying to find the strategy that wins in Excel. But I think we found that the best strategy isn't the one that makes the most money on a spreadsheet.
No. The best strategy is the one that lets you sleep at night. It's the one that stops you from panic selling when the whole world looks like it's on fire.
In crypto, the winner isn't the smartest person in the room.
It's the one who is still standing, still holding, when the next cycle begins.
Just stay alive until the next cycle. That's the mantra. Thanks for joining us for the deep dive.
We'll see you next time.